All right, let's talk Northwest Bank shares. They just dropped their Q4 results, and on paper, it looks like a total home run, a clean beat. So what gives? Why did the stock basically go nowhere? We're going to dive into that earnings call and figure out what the market is really thinking. Okay, so here's how we're going to break it down. First up, we'll look at those headline numbers, the beat itself. Then we're going to get into the bull case, the story management is telling. After that, we'll check out their game plan for 2026. Then comes the interesting part. We'll dig into this one single number that's probably got investors a little nervous. And of course, we'll wrap it all up with our rating, the next call. All right, let's just jump right in. On the surface, Northwest Bank shares put up a really solid quarter. I mean, they beat what the analysts were expecting on both revenue and earnings. So check this out. Adjusted earnings per share, they hit 33 cents. The street was looking for 31 cents, so that's a nice 2-cent beat. Pretty straightforward, right? A solid win on the profit line. And it wasn't just earnings. The top line was a beast. They posted record quarterly revenue. We're talking nearly $180 million. That blew past expectations by more than $6 million. That's a pretty big beat. And just for perspective, year over year, that's a revenue jump of almost 20%. Wow. Okay, so this is where it gets interesting. You got this great beat on earnings, a record-setting beat on revenue, and the stock? It did nothing. Basically traded flat. So what is the deal here? That disconnect is exactly what we need to unpack. So to really get the bull case, you have to listen to the story management was telling on the call. And let me tell you, they sounded very confident. They were painting 2025 as this huge success story. The CEO, Lou Torrio, he got on the call and right away called 2025 a transformational year. And the absolute cornerstone of that transformation, it was their big acquisition of Penn's Woods. They bought it, they integrated it, and it really scaled up the whole operation, making them a much bigger bank. So when you break down the actual drivers for the quarter, here's what you see. First, that Penn's Woods acquisition is now fully baked in, and that was a huge boost to revenue. Second, their core profitability metric, the net interest margin, or NIM, actually expanded to a really healthy 3.69%. Third, they got more efficient, they kept a tight lid on expenses, and finally, it just looks like solid execution all around. So there's your bull case in a nutshell: scale, better margins, and good cost control. Okay, so that was Q4, but how does all that success translate into their plan for next year? Well, management wasn't just patting themselves on the back. Nope, they laid out a really specific roadmap for what 2026 is going to look like. And what's really telling is just how clear their guidance is. They're projecting another record year for revenue, somewhere in the ballpark of 710 to 730 million. They think they can keep that net interest margin stable right there in the low 3.70s. Plus, they gave a nice tight range for their expenses and are forecasting some steady loan growth, low to mid single digits. When a company gives guidance this specific, it's a huge sign of confidence and predictability. So really, the playbook for 2026 is simple. Do more of what worked in Q4. They're going to leverage their bigger size from the acquisition, try to keep those margins stable, even if the Fed starts cutting rates, and just keep a death grip on expenses. It's kind of that classic boring is beautiful strategy. But if the story is so good, if the results were so clean, why the flat stock price? This, my friends, brings us to the bear case. And it all comes down to one specific, very large number. $19.2 million. That's a big number. And that was the size of a single charge-off. We're talking about one loan that the bank just had to write off and accept they're never getting that money back. When investors see a number that big from a single loan, it immediately raises some serious red flags about, what else might be hiding in that loan book. Now, to their credit, management jumped on this right away. The CFO, Doug Schasser, he explained that, hey, this isn't some new disaster. This was a really old loan, a student housing project from over a decade ago that they've been dealing with for years. They finally just ripped the Band-Aid off. So their message was crystal clear. This is an isolated incident, a cleanup, not a new trend. And right there, that's the battleground. On one side, you've got management saying, hey, we're transforming the bank, we're cleaning up old messes, the future's bright. But on the other side, you have the market. And let's be honest, the market is still super nervous about regional banks. So it sees a nearly $20 million charge-off and just can't help but wonder, what's the next surprise? What else is in there? So, how do we square this circle? How do you weigh these two completely different stories? Well, it's time to put the bull case and the bear case right next to each other and come up with our rating for the stock. Okay, let's lay it out. In the bull corner, they absolutely nailed a huge acquisition. Their guidance for margins looks solid and stable, and you've got a management team that sounds like they know exactly what they're doing. But in the bear corner, that giant charge-off just leaves this nagging question about credit quality. The fact that the stock didn't move tells you the market isn't sold yet. And look, there's always a risk they don't actually hit those 2026 numbers. So when you weigh all that, we're landing on a rating of market perform. Look, operationally, it was a fantastic quarter, and their guidance looks totally achievable. But that credit issue, it's just too big of an overhang to ignore. The market is basically saying, show me. They need to see a squeaky clean quarter, maybe even a few of them, before they'll really buy into this cleanup story. Until that happens, the stock feels like it's priced just about right. All right, so let's talk about the next call. Here's our thesis. We think Northwest is going to execute their boring is beautiful plan just fine, but that fear about credit is going to keep a lid on the stock's valuation. This actually sets up a pretty interesting trade idea, a pairs trade. You could go long Northwest bank shares and at the same time go short a regional bank ETF like KRE or maybe another bank you think has more risk. The logic here is simple. You're betting on Northwest's relative stability and execution to win out against a sector that's still facing a lot of uncertainty. Of course, remember, this is not financial advice. And so that leaves us with a big, lingering question, right? Management has laid out a clear plan. They've proven they can execute. So is just one, clean quarter on the credit front all that's standing between this company and a major re-rating from the market? Could that be the one thing that finally convinces investors that their transformational year was for real? That right there is the key thing we'll be watching for on the next call.